The way we get to asymmetric returns is just by being patient. I don't remember the last time we bought something that didn't have a value add component to it, right? Anybody who wants to get alpha or asymmetric returns or, try to beat the S&P has to do it with some type of value add component.
There's a huge dislocation and expansion in cap rate if it doesn't check every box. What you're finding is that if it doesn't work for an institution, you're getting significant yield in the multifamily space.
Office building, bought it at 3.5.
Heart of Beverly Hills.
Yeah. We saw a value add strategy to it. Wells Fargo gave us back 20,000 square feet, kept 8. We took that 20,000 square feet and took it from 30 cents, and now we're leasing it at about $7.
In the 10 years I've been in the industry, everything was negative leverage. It doesn't matter what the property is today, what can the property become? That's completely switched. I saw you wrote a book.
I did.
When did you write that book? And what is it called?
Money and Morons. Money and Morons is basically about the national debt. We're on an unsustainable path. We're not going to solve this problem. It's going to lead to crisis. And that's my conclusion in the book, and my suggestion to everyone is, just prepare.
All right, welcome to another episode of Deal Flow Friday. I'm your host, David Moghavem, and today we got Paul Daneshrad, founder and CEO of Starpoint. Paul, thanks for joining. How you doing?
I'm great. Thanks for having me.
It's nice to be back in LA and get to leverage my network, aka my dad's friends, to get people on the pod. And at first, I reached out to Batman and he's like, no, you need to talk to Paul. So I'm glad I got to talk to you, the brains behind the amazing company you built. I've seen you guys from afar and up close. Actually, when I started in the industry, I looked at the Wave on Third deal that you guys were doing, and then seeing what you guys have pivoted in different strategies and targeting different type of opportunities in all different type of sectors, right? Multifamily, retail, industrial, ground up, existing. And so I'd love to dive into what you're seeing today. How are you, and I've heard you from before, targeting asymmetric returns. How are you targeting that in today's environment?
Well, welcome back to LA.
Thank you.
I'm sure you don't miss the humidity of Miami. I know we were just talking about that.
It is hot in Miami right now. So I think any excuse to kind of get out of that humidity is nice. But come November, I think you could find me back in Miami.
Oh, yeah, absolutely.
Yeah,
Miami in November is the best.
It's really the best.
Yeah.
I hope you could come visit. I think it'll be good to show you around a little.
My wife and I, Shadi, we like Miami. We come once or twice a year. So next time we're there, we'll come sail.
I mean, honestly, the energy in Miami right now, sorry, we're going a little, off topic, but the energy in Miami is incredible. Like you walk around the streets, from an investment side, you understand like the money's flowing there. But when you actually are living there and you see the restaurants are just like super busy, like you go on a Monday or Tuesday and everything is packed still.
Yeah.
The energy, it's justified.
Yeah.
And so we love it there.
It's a great town.
Yeah.
So you're back to your question. What are we doing to deliver asymmetric returns? I love this Buffett quote. Buffett's a mentor of mine, and I quote him a lot everywhere. Actually, if you walk into our office, we got this big, I think it's like 6 feet by 3 feet poster with one of his quotes on there. One of his quotes about discipline. But yeah, the way we get to asymmetric returns is just by being patient. And, the Buffett quote that I was about to refer to was, it's easy to get rich as long as you do it slowly. His quote goes on to say no one wants to get rich slowly. Everyone wants to get rich quickly.
Especially like the Gen Z generation,
yeah.
Right? It's amplified now.
Absolutely.
Yeah.
Oh, yeah. There's no patience, right? Especially in the age of social media where you just constant stimulation and you want, everything fast.
Right.
You want your food fast.
Instant gratification.
Right. You want your media fast. You want to get money fast.
Your returns fast.
Return fast. So yeah, we get to asymmetric returns or alpha mainly through patience. Making sure that we're disciplined, we're recognizing where we are in the marketplace, going back to a Buffett philosophy. Are we getting value? Are we getting real value? Are we getting deep value? Or are we overpaying? And real estate investors historically have lacked patience. We're not a patient group as a whole, even though real estate is slow. And most real estate strategies require time, right? Especially when you're in development, right? You're talking now 3.
Oh yeah, you don't see a dollar till you get CFO.
Yeah, exactly, right? 3 to 7 year strategies, right? But even on your side, right, the multifamily value add, right? Those are 3 to 5 year strategies at best.
And we're the quicker ones, right? I think there's longer hold periods out there.
For sure. So patience, I would say that's just sort of a macro philosophy. Going beyond that, if we're talking like specific strategies, we're big believers in the opportunity zone legislation. We've done about 5 OZ projects, both in multifamily and industrial. And where we're really getting asymmetric returns there is the tax efficiency.
Oh yeah, and that's now permanent, right? With the BBB?
Yeah, BBB. Yeah. Gotta love that name. Who else could come up with the name of a big, beautiful bill except for Trump?
Great marketing.
Yeah, yeah.
Always been strong on that point.
Yeah, even as the president of the United States, still marketing.
Yeah.
You would think you get to that level of success or stature and you can just sort of stop marketing. I mean, you get enough exposure.
That's his aura. That's his key to success, right? Is selling.
Yeah. His messaging.
Selling the dream.
Yeah. Yeah, that's a good point. Selling the dream. I like that. I'm gonna have to remember that. So what was I saying? Oh yeah, back to the BBB. Yeah.
So opportunity zones have been huge for you guys.
It's permanent legislation now.
And it's actually interesting because if you talk to most developers, everyone, the common theme is you can buy below replacement cost. It doesn't really make sense to build right now. But with opportunity zones, you look long-term, patience, as you were talking about, and how, maybe construction costs may be higher than what you can build today, but the tax efficiencies, the long-term value is there. And so I think it's almost, I wouldn't say contrarian, but you are building at a time where there is now a lack of supply being built. There was a lot of supply delivered during, pre-rate hike. And so you're actually putting shovels to the ground maybe at a better time.
Yeah. I mean, that supply demand imbalance, depending on the product type, the sub-market, that always eventually comes back into balance, right? Even look at like retail, right? Retail was so out of favor for so long, but the lack of supply over the last 10, 15 years, brought it back into balance. And now retail is one of the darlings of real estate again, all of a sudden, mainly because of the lack of supply, not necessarily that, demand hasn't been increasing. The shift to online has continued that trajectory. So, coming back to that, even if there is an imbalance there's a little bit too much supply, or you can buy below replacement cost or construction cost, we always look at that, as long as you got a long enough hold, it's going to come back into balance.
Yeah. So one of the things you were talking about with patience, you have patience, but you also play in many different asset classes and strategies. You were just mentioning retail and construction, and I know you guys do a little bit of value add multifamily as well. I guess what's the constant in your strategy as you're kind of shifting different asset classes and pivot to different strategies? What's like your constant that kind of is your North Star in finding these asymmetric returns?
Yeah, so we do shift our strategies to where we feel like we're going to get better returns or asymmetric. And when we say asymmetric, what we really mean is reducing risk and look
Returns excess of market alpha, like your edge, right?
yeah,
That's the way I interpret it.
yeah, but also it's really how do we reduce risk further? Even if returns stay the same, if we can reduce risk, so
Protect downside.
yeah, protect downside. Another Buffett rule. He goes, "There's 3 rules in investing. Number 1 is don't lose money. Number 2 and 3, go back to number 1."
Exactly.
Right? Yeah, that's what we're really trying to do is
Right.
limit our downside, make sure we don't lose money.
Survive the down cycles.
Yeah. And so that's what we really mean by asymmetry, right? Less risk, higher returns. And so do we really have a North Star there, especially as we go from strategy to strategy? And that's probably, I guess, our North Star is that, we're not always a hammer and we don't always see a nail, right? When you're a hammer, all you see is a nail, right? So all we used to do was multifamily value add. And so since that's all we did, multifamily value add had to be the right product all the time. It had to be the right, strategy all the time. And I saw that flaw in that because it just wasn't. There are times where multifamily value add's a great investment, and it's what we grew up on and one of our core competencies. But there were markets and shifts and macroeconomic forces where multifamily value add wasn't the right product all the time. And so we did shift. And so we do look for strategies and dislocations in real estate broadly to find higher returns and lower risk. So our North Star is that we'll be opportunistic.
And it's interesting, you're saying that someone like me who's been in multifamily, existing value add multifamily my whole career. And the way I see it, and this isn't at all disagreeing, it's the idea that, especially as at this age, you want to specialize in something, right? You want to be an expert, and multifamily is something where now at this point I'm extremely sharp, extremely focused in that. But I've also seen the drawbacks, right? Where you're at a down cycle where there's other opportunities and other asset classes that are thriving, and multifamily is not the darling, is not what the LPs or the institutional capital is placing equity in. Right now they're in data centers and industrial, and multifamily isn't that sexy asset class that it was maybe 4 years ago, right? Yeah. So that said, I think the way that we've been able to at least capitalize or diversify is geographically, right? Like, what are the geographic markets where maybe multifamily has a better supply-demand balance or has a better supply-side story that there's not a flood of supply hitting it? These are the areas where I'm kind of identifying that there's benefit, that maybe value add multifamily today as a whole isn't as advantageous as maybe some other investment vehicles, but there is capital still out there for multifamily. It's super resilient, and maybe we can diversify geographically, which we've done. So I guess you guys are also geographically everywhere. And so how do you kind of balance the asset diversification with the geographic diversification in finding the right opportunities? Are you guys kind of doing more of like an ad hoc, or is there more of like a general thesis?
Yeah. So something you mentioned, and I think it's really, really important, and we've struggled with this over the decades, which is specialization. Specialization brings an advantage, and I don't think you can discount that, right? You really focus on one product type, do that really, really well, and across the organization, everybody's got a focus. And whether it's on the operating side, whether it's on the property management side or the rehab side, or the acquisition side, that specialization, builds skill sets that become probably a little bit more competitive than a generalist. And so I would advise anybody who's new to the industry, specialize, right? it's hard to be in every single asset class and do it well, right? You need decades of experience. And even then, right, it's hard because the asset classes change. So your specialization is probably smart.
Yeah. And I think from what I've seen on some of your guys' investments, you guys have been really good at identifying parts of an investment that's super nuanced specifics. Like for instance, my wife and I last night were walking past Camden and we saw the Wells Fargo building and you guys put the Gravitas space over there. And I remember actually my dad was looking at that investment and I guess, and you could explain it better than I can, correct me if I'm wrong, but like Wells Fargo had a footprint on there that was under market and you guys had to negotiate with them and something that maybe on paper is like, we can't do this, but you guys found an edge in kind of getting some luxury retail on there to increase the value of the property. And so I think you guys have done a good job at kind of finding those little nuggets in deals where you can find something that maybe someone else who's just plugging and chugging would say, okay, like this return wouldn't work.
Yeah. I mean, the property you're mentioning on Camden Drive, it was a super core asset. We bought it at 3.5 cap.
Office building. Yep.
Yeah. Office building, bought it at 3.5 cap.
Heart of Beverly Hills.
Yeah. Right. In the Golden Triangle, they call it. But yeah, we saw a value add strategy to it. So Wells Fargo had about 25,000 square feet of space, both bank branch and offices. And they had, believe it or not, a 65-year lease at basically 30 cents a foot, annual 30 cents a foot. So they had free rent.
Yeah. They just negotiated that when, like at inception, a long time ago?
They owned the building at one point.
Got it. Okay.
And they sold it to the buyer. And one of the things when they sold it to the buyer is they negotiated this lease for themselves at a really favorable
sale
rate.
lease back for free. Yeah.
Yeah, basically, right? Yeah. It was a sale lease back and free rent for 60 years. So we took a chance because there was no guarantee we were going to be able to renegotiate that lease. But we were able to do so. So Wells Fargo gave us back 20,000 square feet, kept 8. We took that 20,000 square feet and, took it from 30 cents and now we're leasing it at about $7. Yeah.
Amazing. I mean, that value is incredible. That you're doing also prime retail now that you've untapped out of that deal. And yeah, I've seen that on some other deals. I know you have that recently read, you guys have that deal on Roxbury, the garage that you're converting. So I guess my question on just looking from afar, do you guys go in assuming that you can unlock this potential, or are these things that on the fly you're figuring out, or is it a mix of both? Are you protecting your downside and saying, all right, this deal works if we don't do that, but this is gravy? How's your approach with some of these value add components that you're doing on your deals?
Yeah, normally we identify the value add components before we buy it. I'm trying to think. I don't remember the last time we bought something that didn't have a value add component to it, right? It's really hard to get to sort of those asymmetrical returns without value add.
Of course.
There's too much money in real estate today. The capital flows have made it really, really competitive and has depressed cap rates. Institutional allocation to real estate went from 0.5%, and it's probably today around 5.5% on average across all the institutional cohorts. So that 5x increase in capital flow into real estate, you're talking billions of dollars. So real estate's a different business today than it was 30 years ago because of those capital flows. So anybody who wants to get alpha or asymmetric returns or, try to beat the S&P, has to do it with some type of value add component. You know, unless you're going into rural Alabama and buying Class C multifamily,
and which has its own risk spectrum to it, right? Again, we're talking risk return,
Oh,
not
absolutely.
just return, risk return.
Oh yeah, absolutely.
Yeah.
So yeah, everything we do has a value add component. We identify that before we acquire it. We're actually usually executing on our value add strategies even before we close on the property. And all our business plans, again, whether it doesn't matter of the asset class or asset type, we're looking at sort of how to increase revenue,
Right.
How to increase NOI.
Speaking of, institutional capital, I think I've said this multiple times on the pod. Capital raising is definitely harder today than it was pre-rate hike.
Absolutely.
And anyone that says otherwise is probably lying to you. It's okay to admit it, right? How has capital raising been for you guys? Have you seen opportunities now that some of these institutions are maybe out on asset classes such as like multifamily? Are you seeing that as an opportunity? Are you seeing that as a challenge? Talk to me a little bit about capital raising for you guys.
Yeah, we're seeing the same thing you are. The capital's shifting. Multifamily is no longer the darling that it was. Really over the last almost 20 years. The institutional capital loved multifamily. Today, not so much, for all the reasons you mentioned earlier. And so our multifamily value add strategy right now is dormant. One, because of that, it's really hard to raise capital for, but also the returns are, I don't know what you're seeing, but what we've seen, and because we always go out and test the market probably every quarter on our dormant strategies, we're seeing real multifamily value add returns in primary markets, B product, 80s or newer. The returns are really a 14, 15 IRR. People want to try to get to an 18, but they're financially engineering really to get there. And so,
also credit's kind of also returning those returns right now, right? Like if you're investing in like a credit fund for multifamily, because rates are so high right now, like you're hearing some of these returns also hitting like 14, 15%. So it's like you do need to get to the 18, 19%.
yeah,
The question is it out there? Right.
we haven't seen it. I don't know if you have.
I think it's one-offs, right? You can't get that return at scale. I think the way we're solving is not necessarily IRR, because again, anyone can financially engineer an IRR, but we're looking at in-place cap rate relative to borrowing costs, some deals that are positive leverage, that have strong cash on cash going in. It's like back to basics. It's like old school buying multi, like, oh, this is cash on cash. Cash is king. So I think that's like the way we're valuing deals, and the institutions can't get comfortable with that. But what you're seeing is the private capital, the family offices, foreign capital even, they love that. They understand it. They see that there's the dislocation in capital in multifamily right now is actually creating opportunity.
Yeah, again, you mentioned positive leverage. We've struggled with that when we've looked at multifamily value add recently, especially in primary markets, newer product. It's still sort of trading in the 5 cap.
Agreed, because the new product in primary markets there's still institutional capital chasing that, right? There's still that institutional capital they're looking at as buying below replacement cost, buying below peak. They're justifying it in their mind. And that's definitely not hitting high teens returns. That's definitely at best a 15, like what you're talking about, IRR. But I think we like to play a little in like the sub-institutional space where maybe it doesn't check every box. And what you're finding is there's a huge dislocation and expansion in cap rate if it doesn't check every box. It doesn't have to be a 70s deal, tertiary, like we're not touching that. But if it has 2 of the 3 boxes checked, but maybe it's 8-foot ceilings instead of 9, what you're finding is that if it doesn't work for an institution, you're getting significant yield in the multifamily space. Does that translate to a high teens return? Tough on paper, right? Depending on how you underwrite, but you're getting significant cash on cash and positive leverage.
Yeah, there's cash flow there. So that's a good thing.
Yeah.
I remember when there was a 2 or 3 year period of time where people were buying multifamily with no cash flow.
Yeah.
I mean, like zero cash flow.
I mean,
and I was looking at them, I'm like, oh my God, you morons. What are you doing?
In the 10 years I've been in the industry, everything was negative leverage because everyone was solving to a return on cost. Everyone was, especially in the value add side, how can I, it doesn't matter what the property is today, what can the property become? That's completely switched.
Yeah. They're a little more grounded, and underwriting has become a little bit more realistic today than
it's the way it should be. I think it's the way it should be.
Yeah, it'll change again.
Yeah.
I mean, people have short memories, and even though we're going through some pain right now, people are going to forget that market shifts and
people are already forgetting.
Rents don't always go up.
People are already forgetting. Bridge debt is really the root cause of why there's so much capital stack distress right now. Because operationally, these multifamily properties are fine. They're not 95% and sub 1% delinquency, but they're 92% and 3% delinquency. It's not distress, it's just a little sluggish. But the cap stack is completely upside down. And that's because of the bridge debt. Now you're starting to hear groups to get to that mid-teens or high teens return, they financially engineer it by just juicing it up with bridge. And I mean, personally, I'm afraid to do that after what happened last cycle.
Well, last cycle being the one we're in
or this cycle. Sorry, I meant
the current cycle.
Pre-rate hike, doing that and what we're experiencing today. Exactly.
Yeah. I mean, if you look at the groups that bought multifamily, in the thousands of units, and we're buying at 3 and 4 caps using bridge capital, adjustable debt, and then underwriting to 4%, 5% annual compounded rental growth, and are now have lost their entire portfolios. Right? They built up really quickly 7,000 units and lost all 7,000 because of just exactly that. Right? Bridge debt that was 4% is now 8%. And, they were buying at 3 caps. So even if they got some rental growth, they're only at a 4 cap. So they got, they got the property at a 4 cap. They got their debt at an 8. They're done.
Yep. You can't refi that because you're pretty levered up.
You're done.
Agencies are, 8, 9 debt yield. So forget about it.
You're done. So, yeah, that goes back to the Buffett rule. Patience, right? Trying to financially engineer to a return. It works sometimes, but most of the time it doesn't work.
So at what point, you were mentioning how multifamily strategy for Starpoint's a bit dormant at the time for value add multifamily. But if you talk to other groups, at least in multifamily, they say, this is a great buying time. This is a great buying time because of the dislocation in capital. What would make you excited for a multifamily deal today? What kind of yield? And obviously it's geographically specific and vintage specific, but in general, what is, I guess, again, your metric of choice to see, identifying that this is a good deal in the multifamily space in this environment?
So our active strategies today are our opportunity zones and what we call our tenant-centric retail. In both of those programs, we're getting to about, call it about a 25 IRR. The opportunity zone's actually a little bit less. Our opportunity zones, we're getting to about a 22.
But it has tax advantages. Is the return net of the tax advantages, or is that like on paper deal level?
That's all deal level,
Wow, that's great.
right? So
What kind of yield on cost is like a opportunity zone deal getting to? Like stabilized cap rate on total cost, or
So our opportunity zone projects, again, we got industrial and multifamily, and so
yeah,
they
okay,
vary
so it's a little bit different. Yeah,
They vary a little bit, so I'm just giving you sort of broader blended numbers. But on a return on cost, we're getting to roughly a 7.5.
that's great. Yeah, yeah,
But again, those are on 10-year holds too.
Right.
So the IRR sort of shrinks a little bit because of the hold period. So to answer your question, our active strategies today, we're getting north of a 20. And then on the opportunity zones, the tax adjusted is just
incredible.
Yeah, incredible. One thing people forget about the opportunity zones too is there's no depreciation recapture, right? So you've got 10 years of depreciation shelter too, with no recapture. So all the cash flow is sheltered as well, and it's really tax efficient. So that boosts your yields by almost 50%.
So depreciation, no recapture, and also your cap gains from your prior investment gets written off, like you don't pay cap gains. Is that how it works?
No.
Or does it get deferred? Do they still pay cap gains?
So basically on your original capital gains, you pay 90% of it. It gets deferred for a couple of years, but you have to pay it in, let's call it 2 years out.
Okay, got it. So it gets deferred by a couple of years.
And then you pay 90% of it. So you get a 10%
10%
adjustment in basis. But then that was on the original. On the new appreciation, or the appreciation over the 10-year hold period of the new asset, there's no capital gains.
Got it.
Right?
Amazing.
So all that appreciation is now tax-free and no depreciation recapture on top of it too. So the tax efficiency of it just boosts the return. So, really a 22 IRR in an opportunity zone is really closer to like a 35.
Yeah.
Right. On a tax
net of tax. Yeah.
on a tax adjusted basis. Right. So another investment would have to deliver 35 to get you back down to that 22. Right.
Yeah.
That's the way we sort of look at it. So multifamily for us, we'd have to get back to that area of north of a 20.
Right.
Right. Which it probably will never, it might never get there.
I don't think so. It's just, it's a resilient asset class, and there's so much capital chasing it. And especially on the credit side, you have agencies, you have Fannie and Freddie. So when shit hits the fan, you still have leverage that you can get. Maybe it's not the best as it's been, but you can still, there's still a way to borrow. Look at office, for instance, as a case study. When there's no capital, there's no debt, the values plummet. And operations were tougher there too. And so it's resilient, and there's a lot of capital chasing it. So I just don't see that getting to the 20s unless, as you said, it's, the boons, like tertiary markets.
Yeah. You have a rich uncle?
Sure.
Yeah.
Who doesn't?
I don't. I don't have any rich uncles.
Yeah.
But the reason I bring it up, I call Fannie and Freddie, the rich uncle of the multifamily industry, meaning they're always there.
Right.
Right. They're always there. They always have money, and absolutely they lend.
That's a great analogy.
In every single part of the cycle.
Yeah,
right?
It's true. They're always there. They're always there. They're always reliable.
Absolutely.
And that's why multifamily is priced the way it is.
Yeah. And that is a huge benefit for multifamily. I agree with you. It's really a strong factor. There is no,
you talk about risk-adjusted return, that's protecting your downside.
Yeah, that definitely protects your downside.
Yeah.
100%. And there is no rich uncle in office. There's no rich uncle in retail. There's no rich uncle in industrial or data centers. It's just in multifamily, thanks to Fannie and Freddie. So,
Right.
yeah, I do appreciate that part of the sector.
Yep.
Yeah, for sure.
I guess switching gears a little, I wanted to ask you this. I saw you wrote a book.
I did.
When did you write that book? And what is it called?
Money and Morons.
Money and Morons. What is
Yeah.
it about? And when did you write it?
It came out about a little over a year ago.
Okay.
It took me about 3 years to write it. So I wrote it in the middle of COVID.
Oh, wow.
Yeah.
While everyone was baking sourdough and banana bread, you were writing a book.
I did some of that too.
You did some of that?
Yeah.
Nice.
Yeah.
Nice.
Yeah, it sucked. It wasn't edible.
It wasn't edible, but your book came out.
But
just
I got
fine.
the book. I got the book out. Money and Morons is basically about the national debt, and trying to bring more attention to it.
The deficit.
The deficit.
You were talking about that a little earlier, writing about it a little earlier than now. It's talked about a lot more than it's ever been.
Not enough.
Not enough.
You know, we've got some really smart people, some of the smartest people in the country. And I'm talking about Jamie Dimon, the head of JP Morgan, Ray Dalio, the head of Bridgewater.
I'm in the middle of his How Countries Go Broke right now.
Even the head of the head of the Fed has made his comments, and on and on and on and on, that we're on an unsustainable path, right? Our debt to GDP today is at about 130%. And a lot of the studies and the data shows once you pass 100% debt to GDP, you're getting into really scary territory. And we're past that. And we're adding to the deficit every year now, right? We got about $2 trillion in annual deficits. That's another, call it 4 to 6% of GDP every single year that's growing.
And we're trying to get that down to 3, right? That's the goal.
That's the goal, so that it doesn't keep growing, right? But that's assuming GDP goes at 3%.
Right.
GDP is not growing at 3%.
Right.
GDP will not grow annually at 3%. And so it's a real issue, and we're not focused on it. And it'll lead to crisis. The leading thinkers on this issue are 2 economists, Reinhardt and Rogoff. And they wrote a book called This Time is Different. This Time is Different? Yeah, This Time is Different. And basically it's heavily researched, very data driven, and they just show that what happens to countries that just keep layering on debt and deficits. And they show in their research that eventually those countries either default or they go into crisis. And that's the trajectory we're on.
It's also, just reading Ray's book, it also separates from those who own their reserve currency, right? Like the dollar where you can print, or the people who don't own their own currency, right?
Yeah, right. So exactly. I mean, a lot of people who default don't really have a strong currency.
They can't print.
Right, they can't print. And even if they could, no one's buying their bonds, right? So they just default, right? The Argentinas of the world, Greece of the world, Venezuela, and so on. The ones who end up going into crisis are the ones who can print, and they print to an infinity, and then crisis happens, right? There's a loss of confidence, or there's a bond crisis, and that's probably where we're headed. And I don't worry about myself, but I worry about the country, and I worry about your generation and your future.
Sure.
We are leveraging your future.
Yeah.
And your generation, you're letting us do it. And you don't really understand. Most of the world doesn't understand what a fiscal or monetary crisis is. You're talking about like depression level crisis. And so I wrote the book to try to get more attention here. and to see whether we can change our course.
Do you think we'll change our course?
No. When we were at 40% debt to GDP, we could have solved this problem easily, right? It would have been an easy fix.
When were we at 40 debt to GDP?
20 years ago, 15 years ago. It could have been easy fix, right? Raise taxes a little bit, lower expenses a little bit, and you solve the problem. When you're at 130% debt to GDP, there are no easy fixes anymore.
I think it's higher than 130 at this point. All right, maybe I'm looking at the wrong metric. I think it was like closer to 300. Maybe I'm reading the wrong metric. I just remember reading Ray's book. We'll check it.
No, so your 300 is accurate if you include off-balance sheet debts.
That's what it is. Okay.
Yes, which, by the way, those off-balance sheet debts are real and they're coming, right? That's Medicare, Social Security, those two institutions, the trustees that run them, right, have told us that those two institutions or those two trusts are going to need funding in about 8 to 9 years. Without funding, they're not going to be able to pay what they've promised. And they have to. That's going to shoot the debt up to 300%.
Yeah.
Really fast.
So my friends and I debate about the deficit, among many other things. But one of the things some of my friends say is it's not as bad as people make it seem. Look at Japan. Look at how much in debt they are, and they're not collapsing. It's not a Great Depression. Do you ever hear that comment? And I guess what's your response to that?
So
yes. I guess not picking on Japan, but there's a lot of other countries that are maybe a little bit worse off than America, and we're one of the leaders in AI. I feel like I do believe we can at least grow. If we're going to get out of it, it's to grow our way out, right? So I guess what's your response to that?
Yeah, this is the bigger fool theory. So we can be an idiot because there's just a bigger idiot out in the world.
Right.
Is that the theory?
That's the theory. That's basically the theory. Yeah, you said it right.
Okay, yeah, that's why the title of the book is Money and Morons.
Right.
Yeah, Japan has higher debt to GDP than we do, right? They've had a stagnant economy for 20 years. They've wiped out. Japan had the highest savings rate almost in the world per capita. The highest savings rate. They wiped it out. It's gone, right? Look at Japan's savings rate 30 years ago to now. And it's a result of the debt, right? So they've got some of the lowest savings rate now in the world. So yeah, I mean, if we want to be one of the idiots in the world stage, then yeah, we can just look at who's more of an idiot and say, okay, we're fine.
Right.
We're an idiot, but we're not as big of an idiot as they are. I don't see that as
right. No, that's a fair point. Fair point. I do.
Reinhardt and Rogoff, here's another way of looking at it. If history matters, and this is why they called their book This Time is Different, because everyone keeps saying, well, it's different now.
Yeah.
Right? Yeah, Japan's got 300, so we can do it. No, it's a new age, and AI is going to come in and save us, and we're going to grow our way out of this. And no, we can print our money, and they're always going to want our money and our bonds. That's why they said this time is different. It was more for them being sarcastic.
Right.
It's not different. Reinhardt and Rogoff's research has shown that basically any country that surpassed about 120% debt to GDP eventually either defaulted or had a massive crisis.
It's a death spiral,
yeah.
as Ray puts it.
No one's been able to get out of it.
Yeah, and we're at a point where our interest rate, our interest payments are higher than our defense spending.
Yep.
And so this is the beginning of the death spiral, as Ray puts it.
So Japan's going to eventually have to face the music. So are we. We're not going to solve this problem. It's going to lead to crisis. And that's my conclusion in the book. And my suggestion to everyone is, just prepare.
How are you and how is Starpoint preparing? Because I think with all the grim the grimness of the deficit, I think there could be opportunities on the investment side. Has Starpoint, I guess, identified, or are you looking for ways to, I guess, capitalize for this inevitable demise?
Yeah, when the crisis comes, sort of the Kennedys and the Rockefellers of the world, they made an enormous amount of wealth by when during the Great Depression or during recessions, having liquidity and buying literally 5 cents on the dollar.
Mm-hmm.
So when the crisis comes, there's going to be great opportunity. It's going to, but there's not going to be a lot of people who have that kind of liquidity to take advantage of it. One thing we're doing, we're deleveraging. So we used to have a target benchmark for leverage at about 60%. We've reduced that down to 30.
Oh, wow.
Yeah. So our target benchmark for the
And
leverage,
are you disposing assets and using that equity to deleverage existing assets?
No, everything's, so there's no IO loans for us anymore.
Right. So just paying it down.
So everything has to be amortizing. Mm-hmm. We'll try to get 25-year, 20-year amortizing loans versus 30, even though we can get 30. And when we refinance, we will no longer cash out. So our target is 30. Today, where are we at? We're at about 46%, right? So we still have some time to get to that 30, but we'll get there. The coming debt crisis, it's not next year, right? We have time. Time right now is our friend. We won't solve it because to solve it is going to take such draconian measures. Nobody's going to vote for that. Mm-hmm. This is not a political problem. This is a populist problem.
Right.
There's nobody who's going to vote for higher taxes, lower entitlements, right? Lower Social Security, lower Medicare, lower subsidies. No one's going to vote for that. Part of the population will vote for higher taxes. Part of the population will vote for lowering expenses or lowering entitlements. But
not both.
we need the entire population to vote for both.
It's a fair point. One thing I would say is you still need to, you're assuming everything is stagnant, where if you get higher taxes and lower expenses, it's not going to crash the economy, right? And so is that really the solution? You can't tax and lower expense your way out of this, it feels like. It feels like we're already past that.
Yeah, that's really smart. What'd you study?
What did I study? Finance. Finance. I was in engineering at one point, but yes.
You're absolutely right.
Yeah.
That's what I'm saying. There's no easy fix anymore.
Yeah.
There's no just simple, I'll just do this and we'll be able to get through this with a little bit of pain.
Right.
This is going to require real pain. So absolutely, higher taxes and lower entitlements or lower expenses is likely going to put us into a recession.
Yeah.
And GDP is going to shrink.
Right.
Yeah, absolutely.
Okay. Well, this was amazing. I'm glad that we got to go macro together.
Yeah, we did.
And I'm definitely, your book is on my queue at this point. So I think as soon as I finish.
Read Dahlia's. He's a lot smarter than me, a lot more accomplished. And he's got the same thesis.
Yeah. Well, I'm going to read both. I'll read both. I do enjoy reading, especially about the deficit. And Paul, it was really great to have you on.
Thank you for having me.
And great to sit down with you. And please let me know next time you're in Miami.
For sure going to. Yeah.
We'll link up.
I'm not going to come in August.
Yeah,
but as
you won't find me there either.
You're in
exactly.
LA.
Yes, exactly.
All right.
Thanks again.
Thanks.